liabilities that must be estimated. And first we'll talk about estimated warranty payables. When we talk about warranty payables, we're not talking about here when someone comes into a business and wants to purchase an extended warranty. That's not what this is. When a company sells a product, they anticipate a certain percentage of those products may be defective or a customer not be satisfied and they return them. So they have to record a liability and an expense in the period of the sale. This is due to the matching principle. So if we make a sale, let's say in the middle of December of 2008, then this product probably has a 30-day return policy potentially. So the customer may not return it until the second week of January, which is another business year. And therefore, we need to record that potential expense in the current year because that's when we made the sale. So remember, the matching principle says we record our expenses in the same period as the revenues that those expenses created. So to journalize this transaction, we're going to debit what we call warranty expense. So we have recorded the potential expense, and we're going to record an estimated warranty payable for this liability, this potential liability that we're estimating here that will happen. And we do this because of the matching principle again. The other type of liabilities we have to estimate are called contingent liabilities. Contingent liabilities are potential liabilities, and these liabilities depend on some future event. So what is the likelihood that a future event would create a liability? If the likelihood is remote, then we're just going to ignore it. For example, a frivolous lawsuit. However, if the likelihood is reasonably possible, then what we would need to do is describe the situation in the notes to our financial statements. We wouldn't record it in the books, but we would put it in the notes to the financial statements, letting our informed investors know of this potential, reasonably possible actual loss or liability. Now, if the likelihood is probable and the amount of the loss can be estimated, we would actually journalize this transaction and it would be recorded as an expense and an actual liability based on these estimated amounts. This is the principle of conservatism. So let's look at an example. So here we have the accounting records of Durango Ceramics, which includes the following at December 31st, 2007. So we have a little balance in our estimated warranty payable there of $3,000. So in the past, Durango's warranty expense has been 6% of sales. Durango made sales of $100,000 and paid $7,000 to satisfy warranty claims. So we're going to journalize Durango's warranty expense and warranty payments during 2008. So the first thing we have to do is figure out, well, what are those estimated warranties that we're talking about here? So we're going to take our sales of $100,000 times the warranty expense that we know from our past being 6% of sales. So we get $6,000. So we're going to debit our warranty expense for $6,000 and credit our estimated warranty payable account of $6,000. Then of course, once we journalize that, we're going to post it up top in our T account there. So we're going to credit our warranty payable for $6,000. That's what we debited the warranty expense for. Then it says that we paid $7,000 to satisfy warranty claims. So we're going to take that out of the liability account. So we're going to debit warranty payables for $7,000 and we will credit cash for $7,000. Then of course we need to post that to our T account. So that will be a debit to estimated warranty payable. So our credits are $9,000, our debits are $7,000. So we end up with an ending balance of $2,000. This is the matching principle again. Remember, we want to record expenses in the same period as the revenues that those expenses created.